I think one of the biggest things is take the opportunity to meet with other leaders at the company to gain experience from them. You know, you have a lot of knowledge coming from your professors and from your courses and books, but there is a vast amount of wisdom and experience that exists right in the company that you're joining. Make sure you engage with those people. Most people in the industry, I find, love talking about the industry and how to make you and your career better. So just take advantage of that opportunity. There is no typical day. I think that's probably the answer you probably get from a lot of leaders, especially in a small company. We have a very distributed workforce within the company, a decentralized leadership. I allow people to come into my office whenever they want to, when they have a question. So I think the biggest thing that then creates is it's kind of a rotating door. 1 minute you're hearing about an IT issue that you need to get involved with, then underwriting is coming down, HR, accounting, finance, you're dealing with a board of directors. So I think it's the variety and making sure that you focus. That's probably one of the biggest things. You just have to be very focused when you do get on something, because you can get easily distracted and it's hard to get back to it. The most challenging part is taking a company that has the legacy of 175 years and making sure that it lasts at least the next 175 years. You know, some people say, well, Steve, don't you mean the next 15 years until you retire? And it's not, because you can't just get it to the finish line and then hand it off and hope they can take it forward. You have to leave the company better than it was before when you leave. And you have to give them a good foundation in order to exist. So that's probably the biggest challenge, is just making sure in this ever-changing world of technology, of the way the consumers demand their products and services, of just making sure that the company runs forward in a very successful way. But it's enjoyable too. The biggest thing is going back to that legacy, to be part of that, to know that I'm running a company that's 175 years old. With that, it's everybody you work with. I get the greatest joy when I walk in the door each day of meeting with everybody that makes it happen. My job is to set the strategy, make sure the vision is working at the company, and make sure I communicate that effectively to everybody. Yeah, I answer a lot of detailed questions, but that's my primary job. And last is to set the culture of the company. And that's a huge difference. You can grow a company and be very demanding, or you can be a leader growing a company and be very conciliatory and working together as a team. And I think the fact that we're a mutual company just means that we need to work together as a team within the company. So when we can have the successes we've had over the past several years and work as a team in doing it and enjoy and celebrate together, that's the most fun that I can have. I mean, the day here today has been great. I really wasn't quite sure what to expect. Certainly I got a lot of information on briefing on what I would be going through during the day. I was immensely impressed with how well run everything is, how attentive the students are. You know, I figured I'm going to be in front of students, you know, and they would kind of be engaged, but, you know, wondering, you know, I got to get to lunch for my next class. But everybody was truly engaged and really listening to what I was providing as information. I think they really took it to heart to say, you know, here's my opportunity to hear from somebody that's been in the industry, an industry I want to base my career in, so I want to take every opportunity. So I think it goes back to the staff and the professors making sure that they communicate that down to the students, and then the students living up to it. But I'm just impressed by the people here in the program. It's just phenomenal.
Thank you very much. Well, good morning. It's afternoon. I told myself I was going to say good morning, and I did it right on cue. Thanks for having me here today. Well, I should say good night. We'll get there. So thanks for having me here today. Really honored to be part of this speaker series. I went through a list of your prior speakers and got to hear or got to see who you had heard from over the years. Really impressive list, so to be part of that is just great. One of the things I noticed in going through that list and preparing for today was I didn't see a lot of mutuals. And as we are a mutual, always been a mutual, I thought I'd take a little bit today and give you some perspectives of how mutuals view the industry and what you might expect a little bit different from mutuals versus some of the stock companies that you see. With that, I'm just going to give you a little brief history. You heard about some of the bio that Patrick gave. My career is a little bit different than you've probably seen from most and probably that you experience. So I put up one company, one career. So I started at Harford Mutual when I was 17 years old out of high school. Started with IT computers, and I went to school at night. And so those opportunities were really great then, and I was able to grow it through the company over the last almost 32 years and really experience the company and take it to the next level. But another thing is, I started as a farm kid. So if any of you are thinking you got to be from a business family or anything like that, I grew up on a dairy farm. Before I came to Harford Mutual, I was milking the cows literally the day before. So this is where you can go if you really put your drive towards it and learn. So right after that, like I said, in 1985, I became a microcomputer programmer. That was 2 years after the IBM PC even made it onto the scene. So everybody was trying to figure these things out, and they brought me in right out of high school in order to figure them out. A few years later after that, I took over the IT department. And one of the very unique things, especially in a smaller company, is a lot of companies write their own software. I was a programmer, moved up through the management ranks. So in order to program all of our systems, we had to learn how to do everything at the company. You had to learn to be an underwriter, how to rate, how to be a claim examiner, how to go down in the mailroom and process in order to then go back and then program that into our systems. And that was invaluable to me in my experience in learning through the company. And then I became the CFO. Now this was a pretty big leap, small company, but I did have a minor in finance in college, so it does come in handy. What was really good here is I had the complete operational experience at the company, and then I brought in the balance sheet and the income statement. And over those next 2 years, really was able to formulate and get a full understanding of the company in order to then, in 2006, become the 10th president, as you heard, of the company. At the time, I was 39 years old. And I don't say that as any way to impress you. I say that just because I was scared out of my you-know-what. Because I'm thinking, how am I going to take this company that at that time was 164 years old and take it into the future? And that's essentially what the board told me when they named me the new president and CEO. They said, we want you to create a new company. So essentially a 164-year-old startup. They also made the qualification, we don't want you to upset the apple cart. So that means don't fire anybody. So that makes it very difficult to take a company and transition. And you'll see some of these things as we go along. You take our history here, you can see the first 164 years, we only grew on an average of $680,000 a year. Then 10 years, we've grown $7.3 million a year. And if you really concentrate on the last 5 years, we've grown $14.4 million a year. Now, there's a lot of big, giant companies out there, but for us, these are tremendous numbers and how we're growing the company. As you heard, I'm very involved in the local associations for the industry, especially for mutual. So anywhere you see MAMIC, that's Maryland Association of Mutual Insurance Companies, Pennsylvania, and I am the current NAMIC chairman. So we represent 1,400 mutual companies across the U.S. and in Canada. And I took over that chairmanship in September to this September. And very active in the community. And you'll hear me talk about this. Mutuals are very integrated into the local community. That's where they came from, and that's why we continue to give back to them. A little bit on Harford Mutual. We've been around for 175 years. We have 152 employees and about 400 plus independent agencies. Our size, just to give you some perspective, last year we wrote $185 million in premium on a direct basis and about $163 on a net basis. So that means after we give money to our reinsurers that give us a lot of protection, that's our net revenue that we have at the end of the day. What we're most proud about is policyholder surplus. Policyholder surplus in a stock company that would be called shareholders' equity. This is the capital of the company, $209 million, which leads to that last item, which is leverage. So net written premiums to surplus is typically how you look at a company's strength. Well, it's the same as how much have you maxed out on your credit card versus how much do you have in your bank to pay those debts. It's the same thing. And the more we have in surplus, the more we can ride through the tough years and move forward, and we're a stronger company before it. Here you can see our footprint. We're really a mid-Atlantic company. We're based in Maryland, just about 50 minutes north of Baltimore, not too far here from Philadelphia, about an hour and 20 minutes ride up here. And we have been slowly growing through the mid-Atlantic area. In fact, we just expanded into South Carolina and Georgia, and we'll probably start writing business there next year. Lastly, you can see our primary lines. One of the differences with Harford Mutual that you find with most mutuals, especially smaller mutuals, we are commercial only. We do not write any personal lines business. We stopped writing personal lines about almost 20 years ago when we became very focused heavily in the commercial space in order to distinguish ourselves and really bring value to the marketplace. What's very important for any company is to have a purpose and a strategy. And they're very different. A purpose is why do you exist? How did you come to be? A strategy is where you want to take the company. Think of this as more the vision. But you have to know how you're going to get there and explain that. This is extremely important for all companies, but it is very, very important for mutuals because we focus on purpose. And you'll understand why as I start going through some of the differences. We are very long-term focused. Stock companies tend to be very short-term focused. They're looking at the results on an annual or even quarterly basis, whereas mutuals look at it over multiple years. We'll take a bad year in order to maintain stability in the marketplace, which is a little bit different than some of the stock companies. Growth is important for us. Now you can say, Steve, you've been around for 175 years, you've only grown essentially about $1 million a year. That doesn't sound like big growth to us. That's pretty big for actually a mutual because we're always focused on growing our surplus, not our revenue. That's the key, and you'll see why in a minute. So revenue, pretty much the saying is if you look at a company's financials, if they're not growing, they're dying because your expenses will eventually catch up to you and you won't be able to overcome them. Profitability is the main key for a mutual. You must have profitability in order to sustain the tough years. And you can even see here back in 10 and 11, we had some pretty tough years because of the winter. If any of you remember, we had blizzards those 2 years and really created bad years. But you can see our very consistent results that actually outperform the industry. Most important though, this is great to grow here, and you can see our tremendous growth over the last 6 years. But this is where we really have to grow. This is your bank account growing down here. And so to be at a 209 million when we started at 180 10 years ago, that's extremely important and to the survivability of the company. Just going to give you a little perspective of how did mutual companies even come to be. They really started all the way back in the 17th century after the Great Fire in London. So everybody came around and said, we need some way to protect our assets. And the actually first company was a stock company, not a very big name, insurance offices for houses. They weren't very imaginative back then, evidently. But then the first mutuals, and if you'll notice, some of the very early mutuals loved to use as many words as they could in their name. Contributors for the insuring houses, chambers, or rooms from loss by fire by amicable contribution. I hate to see that on their letterhead, but they thought the more words, the better. So I got a question for you. So if we go to 1993, here in this day and age, if you had this one, purveyors of overpriced, carbohydrate-laden Tex-Mex meals sold to the masses of starving young adults after waiting in line for longer than it takes to eat the meal itself is, there you go, Chipotle. Good job. So how did mutuals really start expanding? The first one was down in South Carolina. They only lasted 4 years. The problem back then in the 18th and 19th century, everything was made out of wood and they cooked with fire. So eventually it's going to burn. Everybody was closely together. The whole town burns down. Well, the company went out of business 4 years later. Does anybody know the oldest insurance company still in operation here in the U.S.? Anybody know? It's located right here in Philadelphia. There you go. That's what we know them as, but here's their very long name. The Philadelphia Contribution Ship for the insurance of houses from loss by fire, founded by Ben Franklin and a bunch of other folks here in Philadelphia, still exists today. If you ever have the opportunity to go to the museum, I'd certainly welcome you to do it. You can see Franklin's name signed on many different documents. It's really pretty cool. And then INA was the first stock company here in the U.S. that came about. And then mutuals spread as the company grew, or as the country grew, and of course that was mostly here on the East Coast, so did insurance across the whole mid-Atlantic. But really, what created the mutuals across the U.S.? It was really the Homestead Act. So this is when the government said, we want people to get out of the East Coast, we want you to go west, and if you go west, we'll give you 160 acres. So here's all these people that go across the U.S. to start creating towns and their establishments and farms, and they need somebody to insure them. Ultimately, this created what's known as granges. They came together as associations to insure themselves because none of them trusted all the banks and the insurance institutions back in the East. There's a very big divide, and so that created the bulk of the mutuals we know today. Of which, you should know that there are many mutuals out there, small and large. Harford Mutual, but also State Farm is a mutual. USAA is a mutual. Preferred Mutual, Penn National, or some right here in the New York and Pennsylvania area as well. Harford Mutual has a long, long history, 175 years, and you'll find that this is very common with all mutuals. Many mutuals are at least 100 years old plus, and they love their history. Don't mistake that for they're old and stodgy. It just means they have a lot of history and a lot of legacy that they want to make sure that they continue forward into the future. And that's what we want to do here as we celebrate 175 years. So I thought I'd just take a few minutes and really just go over some of the key points between stock and mutual companies so you can have a perspective. Keep in mind, I'm not bashing stocks, I'm not praising mutuals. They're just two completely different models, but there's some significant underpinnings that you need to understand. And the first is coming from this study that was just recently done by a professor down in Alabama that really talked about this, so it was good timing, so I pulled a lot of that information out of it. And the main principle is who owns the company. So we all know for stock companies, it's shareholders. You buy stock into the company and you now have a say in how that company's run. Mutuals are owned by the policyholders themselves. Now, they can't run in and sell their policy back for some kind of equity, but they have a say in how the company is run, and we'll talk a little bit about that as well. There's an inherent ownership conflict when you look at stock versus mutual. When we say stockholders and policyholders, you can easily say owners and customers. Your shareholders don't necessarily buy a policy from the stock company. They want to make sure that company's deploying capital and making profit year in and year out. Mutuals, you're a customer, you want to make sure your claim is paid. You want to make sure you get good service, and that's what mutuals focus on. So what's the easiest for the finance folks? What's the easiest way to manipulate the underwriting results at the end of the year? Easiest way. Yep. And what's the easiest way to manipulate the surplus? Get more surplus. The loss reserves. Very good. Easy to just change the loss reserves. Put more up, or take some from IBNR. So you'll constantly hear, when you hear reports, of constantly letting reserves down. Well, there was a study done in 2016 that showed that stock companies, they can find a clear correlation between reserve releases and incentive pay for the executive. Because if I lower it and I get a lower combined, I get a bigger bonus. But what does that do to the company? It positions them in a weaker position going forward. Ownership rights, what's the difference? If I own stock in a stock company, I can sell that stock on my own. I don't need to get anybody else's buy-in. I just go in, I say I don't want this stock anymore, I get rid of it. I'm no longer a shareholder. Very different with mutuals. Mutuals, they can't come in and tell us what to do, or policyholders can't tell us what to do, but they have to work in a collective agreement. They can come to the annual meeting, they can ask for changes, they have policyholder rights in order to make sure that the company operates in the way they see fit. but they have to do it together. Remember, mutuals formed in towns by communities coming together and saying, we need a way to protect our businesses, our barns, our farms, whatever it was. And so that's where these principles all come together and still exist today. So the outlook, and I spoke to this earlier, stocks quarter to quarter. If your numbers aren't hitting where they need to be, you know you've got that stock call coming up. They're going to set the price, and you better push revenue or fix something with reserves in order to get everything lined up right. Mutuals, we think multiple years. If this year isn't good, okay, are we going to be all right for next year? And we just keep making sure that the capital's in place. Very, very different because they're responding to owners. Mutuals are responding to policyholders. The policyholder wants to make sure they're going to get paid. And don't just think, well, losses only last so long. We write workers' comp and casualty insurance. That could be a claim multiple years later. They want to make sure we still have the capital to pay that claim when it comes in. Capital deployment. So all this money that comes in from the shareholders, what happens to it? The shareholders demand that you deploy it. So they take that, they don't want you sitting on a big nest egg. They want you growing and expanding, taking on more risk in order to get better returns, right? That's the only way. Better returns come from more risk taking. It's the way it is. Mutuals, we preserve it. We love to take the money, squirrel it away into investments, and protect it as much as possible. That's why we grow far slower than others. Access to capital. This is one area where stocks truly have an advantage. They want to raise capital. They had a bad year, they just sell more stock. People throw more money at the company, they have more capital. Mutuals can't sell part of their company. There is no stocks to sell. All we can do is make partnerships with reinsurers or banks or investment banks in order to bring capital into the company. It's far more difficult, but that also keeps us far more conservative in our risk-taking in what we do, because that's a much more expensive proposition. And if you ever wonder, how do stocks and mutuals do to customers, customer satisfaction? If your customer is your owner, are you truly satisfying them more? Here's 4 different studies that we all know J.D. Powers has done in 15 and 16, where mutuals on various lines of business and claims handling outperform stocks constantly. Because a stock company is always going to be focused on, I want to give the customer as minimal as I can because it benefits my stockholder. Whereas we think we want to take care of our customer because they are our owner. Very different. And if you wonder, are mutuals shrinking or are they growing? It's actually, they're growing. In 1984, they were 38% of the market. In 2015, we're 44% of the market. They dominate in farm owners, homeowners, and personal auto. And these are some areas of just talking about the fact that mutuals are expanding into commercial insurance more and more in order to differentiate and meet the demands in the marketplace. Just want to touch real quick, because I'm talking to all millennials here pretty much, a couple of folks that aren't. So this is what you guys look like on this side when you come in. You've got your suits, you look all great. You just came out of college, you don't understand personal space at this point. You're touching each other, okay? So then you go into this one, and what happens? We put you through sexual harassment training that put your hands in your pockets, and you think you own the world, so you don't even wear a tie anymore. What you need to understand, no matter where you're at, in what group, you're going to be working in a very multi-generational workforce, the biggest one we've ever seen in this country. You're the largest segment of that being the millennials. You just took over last year being the biggest segment in the workforce. But you have to understand there are people like me that are coming from the Gen X group. We're kind of the glue in the middle of the three. We have the baby boomers who are slowly exiting. We have you guys coming in. And then we have the iGen coming right behind us and behind you. And they work completely different. You learned how to work the iPhone maybe when you were 10. Mom and Dad gave these kids when they were coming home from being born. So it's very different of what they're looking at and what we're going to have to be dealing with here. Last thing I want to deal here is, my slide went nuts. This was a study that Deloitte did last year and really talked about, they polled you all and tried to come up with what means most to you in your job. What are you looking for in a job? I highlighted the ones that you will find in a mutual. Leadership training and opportunities. Now you could say bigger company will allow me to go further, but smaller company gives you access to me. You can walk down to my office or John's office and say, hey, I got this risk, tell me all about it, and they can help you with it. Sense of meaning from work. We give back to the community constantly, not shareholders, owners, so you're going to get a far more close relationship to what we're doing at work than you will in a stock. Professional development, work's impact on society, and some other ones that you see there. Leadership reputation, that's an important one. It made 14 on the list. I don't say that because I'm a leader, but keep in mind, how many stock people do you hear, they took the company down the tank, and all of a sudden they got a big golden parachute on the back end. They're gone. I don't have a golden parachute where I'm at. I'm just gone if I don't have the company performing correctly. So I have to make sure in my community that I'm running this company. I also have 175 years of legacy that is on my back to keep it going. And so does my team. It's not just doesn't sit with me. It runs through everybody at the company. The last thing I wanted to leave you with was just some career thoughts, some things that have helped me that might help you. I'm sure you've heard a lot of these. These are not ideal. Explore. You're in insurance or actuarial side. The insurance space is so broad. Where you go and what you do within it is dynamic. You could be at a reinsurer, a carrier, an agent, an auditing firm. You could be in claims, marketing, IT. Make sure you take the time to explore all the opportunities in each one of those areas. Don't pigeonhole yourself right out of college and say, I'm only going to underwriting, I'm going to be an underwriter. That's it. If you're only 25, you're 4, whatever you are, you've got 30, 40 years of work. Don't just languish in an area where that's not what you really want to do. So explore. Goals. Set goals. This is the most important thing to me. As soon as I was there at 17, the first goal, I still have the piece of paper I wrote it on. I will be the youngest officer at this company. That's all I wrote. I didn't know when it was going to happen. I just said that's going to be my goal. And I looked at it each day, and I did whatever I needed to do to get there. It's okay to dream, but also be realistic. Don't say you're going to be the president in 5 years. You know, put something down that you can work towards that's meaningful to you that you can check in on every so often. Be patient. This is a very conservative industry. We've been around for hundreds of years, and we do that by being conservative in what we do, and you just showed up. So it's okay. Things are moving, and the industry is progressing in technology and everything that we're doing, and there's a lot of disruptors out there, but be patient as you come into this multi-generational workforce in an industry that's been around this long. The last one is learn. Commit to a lifelong learning. You need to do that in whatever you do, but especially this industry. And when I say this, doesn't mean go back to college, get your master's, or get your CPCU. Those are all great things. But take opportunities to get the knowledge from the people on the floor around you. If you're in underwriting and you get the quarterly statement and there's a balance sheet, walk down to the CFO or controller and ask him or her about it. Find out everything you can about that company. Reaching the person that does the work is far better than going to a book. Both are important, but take that opportunity. Enjoy what you do. This goes back to the first one. If you're in the job and you don't like it, get out. That's the biggest way you will fail in your life, no matter where you end up, is if you stay in a job you don't like, because you won't perform well, and either they'll get rid of you or you'll move on and you'll miss an opportunity before that. And the last thing, focus. Have a clear intention of what you want to do in life. It's okay to explore, go backpack for a few months before you get a job, whatever it is, but have a focus once you sit down in the job. This is very important, especially if you view yourself as an emerging leader, somebody that wants to race up the ladder. You're going to have focus in order to do that. And one of the biggest reasons, and this is my favorite quote, this is from Winston Churchill, you'll never reach your destination if you throw a stone at every dog that barks. I tend to be a perfectionist. I don't like that label, but I know I tend to go that way. And so every dog that's barking, I want to fix it. Well, guess what? I'll never move out of this position because there's always something you can fix. There's always something else you can look for. So make sure you line your goal back up, and when there's a dog you need to stop barking, do it. But if it's not, move on to the next one and be successful in what you do. Thank you for your time here today. Yep. Hi. Sure.
My question is related to demutualization. That makes things harder, capital, the insurance, the
Yep.
surplus notes. So I'm just curious, everyone here at Harford, has there been any thinking within the firm that you should demutualize? And if so, where did that come from? And how did it get there?
Sure. It's a great question. Demutualization is happening more often, and there's a number of reasons why it happens. So when a company decides they want to demutualize, there's a couple methods they could do it, and I want to spend all the time, but typically what happens, they create a mutual holding company. The mutual holding company then can issue stock out to raise capital. It does still change the dynamic of the company. You can maintain some mutual principles. Why do they do it? Could be we're doing fine, we get hit by a couple years of catastrophe losses, and our capital starts going down and our leverage gets out of whack. As soon as that happens, the rating agencies are going to start looking at us, and they may pull our rating down. If we don't have a rating, we can't issue. So they want to raise that capital back in. That's the primary reason, and NAMIC is fully supportive of companies that need to form mutual holding companies to do that. Unfortunately, there's a bad side to mutual holding companies, and that's when boards or CEOs like myself get convinced that it's our company. I've been here 10 years. Look, I just made you $100 million. Where's my share? Where's my share? Like, you get that in stocks. CEO probably has shares that they get as part of their incentive. I don't have that access. So what can happen is, comes in, you create that, you sell the stock, all of a sudden you get a share in those stocks that are being sold, and all of a sudden I get rich. It doesn't happen a lot, but it does happen. And we try as NAMIC to push that down as much as possible and stop that by putting in regulations in states to make sure that that's not there, because ultimately that's a fail for the customer. I would win, some of my officers would win, but the customers lose on that. Key thing with it, whenever you demutualize, the policyholders still have what's called subscription rights. So you may, depending on the state, have to go to the policyholders and allow them to be the first ones that are able to buy the stock. And you may have to give them some of the value that they've built into the company in doing so. You may discount the stock price, things like that. Good, great question.
Good afternoon, Steve. Thanks for coming today. You had a great presentation.
Thank you.
My name is Lady Carmela Robinson. I'm currently a junior with management major. And my question for you is, in one of your slides, you mentioned that mutuals have a large percentage of the personal auto market. In your role as the current chair for NAMIC, how are mutuals preparing for the innovation of autonomous vehicles and the potential shift in the market?
Another excellent question. And you see, I saw my time was running out, and I started blowing through some of the slides. One of the biggest challenges, especially to mutuals, is because we are so focused in the personal space. Yes, farm first, but the next two are homeowners and auto. And homeowners is going to be soon behind with all the automation that's going on with the homes. But a large segment of the personal market, auto market, is written by mutuals. And the concern we have there is, as autonomous vehicles starts moving forward, is that there's going to be lower losses, meaning the premium starts coming down. That has a dramatic shift. And so what most mutuals have started to do is diversify. So there's a term I've always used in my 30-some years here of sleepy mutuals. You can look at our performance and essentially say, we just ride from year after year after year. We have this big bankroll behind us, so we just move forward. That is soon ending. And what NAMIC is trying to do is educate the mutuals that they must diversify the book beyond homeowners and personal auto. They're moving into commercial. And so we do extremely well there in commercial, especially in small business, because those owners want that service that mutuals can provide. I think one of the biggest things we are doing as well is educating the members of all the mutuals. So NAMIC, for example, has their first Future of Auto Summit this July to bring some of the experts in down at the International Highway Safety Testing Facility in Virginia to show them what they're up against over the years ahead. It's still going to be a long way out, but you can definitely see that mutuals are shifting more into the commercial space, and I expect that will continue to happen over the next 10 to 15 years.